Do they know what they're doing, and how could they do a better job?
No, I don't think they know what they're doing. They clearly reacted way too late to the inflation. We've talked about this before. We had that surprise inflation print in the summer of 2021, 5.1%. They said it was transitory. They didn't react until November. They continued QE for another 6 months. And they suddenly got hawkish in November of 2021. And they didn't even start the first rate increase until March of 2022. So they were really asleep at the wheel and late to react to the inflation by about 9 months. Now I think they're potentially making the opposite decision, which is they are late to recognize what stress and distress the economy is under right now. And Powell had, there was 3 choices they could have made at this meeting. They could have raised rates, which is what they did. They could have cut rates, which they didn't, or they could have done nothing, basically held pat. And the argument for raising rates is just that, well, we have this inflation problem. We need to keep raising interest rates until the rates are above inflation, and that will bring inflation down. Then you can start to lower rates. That's sort of the conventional view. I think the problem with that view is it ignores that we've just seen a run of bank failures, and there's tremendous stress building up in the banking system from unrealized losses on long-dated bonds, also unrealized losses on commercial real estate loans. And we've barely scratched the surface of seeing that problem. That's, I think, the next shoe to drop in this whole thing. So I think that the right decision here was to either cut rates or to stand pat. You may have seen that Elon said, listen, we should be cutting rates here. There's way too much latency in this inflation data. The economy is seizing up, and we don't need to be raising rates right now. We actually need to be cutting them. I think that probably, if it were me, looking at the upside downside of these decisions, I probably would have just stood pat because, again, we've just seen this banking crisis. Why wouldn't you just wait 1 month to see? Maybe there is latency in the inflation data. Maybe the banking crisis is not over. Why wouldn't you just stand pat for 1 month? You can always raise rates in a month. I think that this move here could, in hindsight, be seen as the straw that breaks the camel's back.
Chamath, would you have paused and waited to see another card and then watch the hand developed? Or do you think they're doing the right thing by raising, or should they have cut?
I think they did the worst thing possible, which is they took the middle path. If you think about what the Fed has the ability to do, they obviously have the ability to raise and lower interest rates. But what we don't talk about is they have a balance sheet that can absorb assets. For the last 10 or 15 years, we've had a phenomenon called quantitative easing. And for folks that don't understand what that means, that is essentially the Federal Reserve buying assets out of the market and giving people money for it so that people can then go and buy other things with that money. Last June, they started what's called quantitative tightening, which is essentially reversing that policy and restricting the liquidity in the system. So if you look at those tools and you sort of play a game tree on what the Fed could have done, I think that you have 2 choices. One is you massively let inflation run amok, where you have no tools to fix, or you have massive illiquidity in the financial system, but you actually do have tools to fix that, which is through some combination of quantitative easing and tightening, depending on how much liquidity you want in the system. So I think, actually, I disagree with Sachs. I think they should have done the opposite. They should have raised 50 bips. It would have created a little bit more chaos in the short term, but it would have set us up to understand what was fundamentally broken and still give the Federal Reserve the ability to use their balance sheet and use liquidity in the future to solve the problem. They took the worst option, which is neither did they cut, nor did they raise enough. And so this problem that Sachs represents actually is the fundamental problem now, which is you won't have enough clarity and signal to really know whether this 25 basis point enough. Look, I've maintained now for 9 months that rates are going to be higher than we like and longer than we want. And so I think it's high time that we acknowledge that we have a sticky inflation problem whose back we have to break. We've known since Volcker era what we need to do that, which is you need to get interest rates to be greater than terminal inflation. which means that a 5% Fed funds rate is insufficient. So we're going to need to see a print of 5.5, 5.75%. And that's when you're going to have enough contraction. And then the Fed can come back with liquidity. But if they don't take these steps, we're going to be in this very choppy, neither here, neither there situation. And I think that is what causes the real damage, because it's the corrosive effects of uncertainty and what that does to lending, to risk taking. And that I think is really bad for the economy.
Freeberg, where do you land? We have Sachs saying they should have stood pat. We have Chamath saying either go hard, take the medicine.
I don't know. I'm not like an economist on judging the balance that they're trying to weigh right now. I think everyone's got a different, you can hear a cacophony of opinions on this one. What I'm more interested in is, we talk a lot about the banking crisis underway, and I know we're going to talk about this question on commercial real estate in a minute. But if you look at the yield on the 10-year Treasury, I think coming out of this past 2 weeks, the yield on the 10-year Treasury dropped from 4.1% down to, looks like it closed at 3.4% today, nearly a 0.7% decline in the past 2.5, 3 weeks. And that's also off of 3.8% since the start of the year. And remember when we talked about the impact on asset values at banks, I think if you look holistically at the roughly $7 trillion of assets held at banks, whatever the set of banks that we looked at, the average kind of equity ratio is about 15%. So, a 3% adjustment over 10 years on the Treasury impacts the value of a chunk of that portfolio down 25%, which starts to put you into dangerous territory. And there's obviously a distribution of what that does to certain banks that are overweight, 10-year bonds, whether they're loan obligations on mortgages or treasuries or corporate bonds or real estate bonds, real estate debt. And so the more encouraging point that I think we should pay attention to is, does the market tell us that these short-term rate actions are driving down the medium and longer-term rates in a way that will improve the balance sheets of all these institutions that own a lot of this debt, particularly the banks and funds and so on? And, I'll do the math here real quick, but just in the last 2 weeks, the impact on the 10-year Treasury has probably had a pretty sizable impact. We talk about unrealized losses. It's reduced those unrealized losses. It's improved them. So I think that that's like the more important metric to be tracking is, if you look at all the assets that we're all worried about right now, are they going up in value or down in value in a way that introduces more stability into these kind of banking systems that we care about? And I think right now it looks like maybe things are improving. And that might be part of the optimism around, equity markets and folks buying and so on.